InFi, episode 21.
Welcome to InFi, the future of finance, hosted by American economist and author Dr. Robert Murphy. Each week, tune in for dynamic discussions with business pioneers about emerging trends in finance, life insurance, asset management, technology, and more. Now, let's talk the future of finance.
Hey everybody, welcome back to another episode of InFi. Today I'm going to be speaking with Herwig Konings, who is, among other things, the CEO and founder of Security Token Advisors and Security Token Group. He has a catchphrase underneath his LinkedIn profile that I like called Wall Street Without Walls with Web3. And I'm going to ask him specifically about that in the interview. Just to read from his official bio, born in Belgium, Jersey-raised, Miami-based, Herwig is a graduate of the University of Miami and has a passion for growing fintech businesses, including pioneering the security token industry. And that indeed he did, as we get into in the discussion. Beyond that, as I do with a lot of these folks, when I find someone that I think is pretty good about just really explaining stuff at a level that the newcomer can understand, but also is rigorous, I prod the person to go ahead and get that done. And so we do discuss a lot of things like, what is Web3? What is tokenization? What's the difference between a security token and a cryptocurrency? Things like that. What's an ICO? Okay, so we do cover some of the basics. So in case you're new to this arena, we go over that. We don't assume anything on the part of the listener. But on the other hand, if you're a veteran in this, we also cater to you as well. So we try to be all things to all people, but I think we pulled it off in this discussion. It was also very fast-paced and pleasant to listen to, I'd like to say. So without further ado, here is my discussion with Herwig. Herwig, welcome to the InFi podcast.
Pleasure to be here. Happy to be here.
Yeah, I'm looking forward to this discussion. So first of all, you've got an interesting background. I was looking at your profile on LinkedIn, and you started out in Belgium, then went to Jersey, and now you're in Miami. So can you maybe just explain a little bit about that and perhaps, what you picked up along the way? Because those are three very separate locales.
Yeah, you're digging down to the root of it. Well, I am a Belgian-born citizen, but a proud American today. We actually moved to the States for my dad's work. He was a corporate executive at J&J. And when that happened, I got to say, I caught the American dream. And I really fell in love with it. Very early on, while I was in New Jersey, I actually started working for startups in New York, where I caught the sort of startup bug and sort of knew I would always want to start a business in technology. And then at the University of Miami, where I went to school, they had a program there that's actually pretty unique. They call it Career Services for Entrepreneurs. So instead of, the usual services of mock interviews and resume help, as an entrepreneur, you need a different kind of help, right? And so I actually worked with students and alumni to actually help them figure out all different aspects of their business, from who their target audience is, how they're going to build it, how they're going to fund it, how they're going to find their team, everything in between. So when you do that all day in and out, it's very hard not to get the bug yourself, to want to launch a business yourself. And so while I was in college, actually over 10 years ago, I started a company called Credify, known as Invest Ready, to the market. We provide accreditation software. And so that's how I got my career into technology, into all of this.
Okay, well, if you don't mind me just backing up a little bit here. So
yeah,
how old were you when you moved from Belgium to Jersey?
6.
Okay, so do you remember what your was the U.S. a scary place? Was it like, oh yeah, they got a bunch of guns in school, or were you too young to?
Definitely too young to look at it that way. I know that it was everyone speaks English, which was a whole new language to me.
That would be another element. Yeah, to me,
that was the element I had to deal with. Yeah, a little daunting at first.
Okay, so and this betrays, as a good American, I know barely anything about anything outside our borders. So in Belgium, growing up, if you had just stayed there, would you have been fluent in English or not necessarily?
English is definitely such a universal language. Everybody speaks it there to some degree. They can understand it. Pop culture is very prevalent there. But the two main languages are Flemish and French, and you'd grow up learning those. And I'll also say that if I never came to America, I'd say I probably wouldn't be an entrepreneur either. I'd probably be doing something else.
Now, so that's an interesting comment. Can you explain why? Is it just because it was so easy what the on-ramping to like a safe career would have been in Belgium? Or is it just
Yeah,
entrepreneurship is sexier over in the US or
you
both?
you nailed it on the head
Okay.
on both accounts,
Okay.
right? The culture, and let's just say I definitely had some challenges with my parents when I decided to
Mhm.
embark on this journey, because that's absolutely right. The culture there is it's a lot safer. Starting a business there takes months to get approved. It's definitely a more unconventional path. Whereas, of course, here in the US, it's endorsed, it's celebrated. So I absolutely fell for it, and I don't look back ever since. I love every minute of it.
Okay, this just pops into my head when you're telling me that you were 6 over in Belgium. We were talking about how you didn't even know English at that point. So, we like, had you seen the Star Wars movies?
No, just some Disney, just a little bit
Okay,
of Disney. Yeah,
okay.
yeah.
And were they dubbed, like, into French or
Oh yeah, they were dubbed. Yep.
okay, alright. That's probably the most important bit of information I'm gonna get out of you in this episode, but it's not something I have asked any previous guest, but it just, like I said, it popped into my head and I realized, "Huh, let
Everybody
me look."
knows.
Like, does this guy even know who Indiana Jones is? You're not familiar with old Indy. Okay, so you came over. So how old were you when you went from Jersey to Miami? It was for college you went to Miami? Did I catch
That's
that?
exactly right. Went
Okay.
down for college, joined that entrepreneurship program, and just basically started my first company there.
So was your dad working in New York City and just going back and forth? Or was he in Jersey?
Jersey, yeah, close
Okay.
by. J&J's headquarters is just nearby. Yeah, in New
Okay.
Jersey.
Okay. And had you so at that point, like just the proximity of New York, is that partly what got your entrepreneurial juices flowing? And
Yeah, that definitely got the tech jolts going. I had the opportunity to work for a number of different startups in a number of different capacities: marketing, business development, project management at a software development firm. So that really exposed me to sort of, actual technology development, software development, as well as, operations and some other things like that. So I really kind of got very lucky, found my passion very early on, and got to work for some cool startups in New York City.
okay, great. Okay, so now jumping ahead to more recent history, the way that many of us at Infineo have interacted with you is through security tokens and the various
That's right.
ventures that you've started. So can you speak a little bit about that, and then we'll unpack it for the listeners?
With pleasure. So, as I mentioned, while I was in school, I started a compliance company. It just so happened to be that the Jobs Act had passed of 2012. This was, the first time any major legislation had happened towards securities laws since 1933 and 1934, and 1940, and some other small changes. But ultimately, this was like, hey, we're going to change the way you can raise capital, and it introduced a lot of new ways that entrepreneurs digitally can raise money, as well as from who they can raise from, right? So I saw an opportunity there because I was dealing with entrepreneurs trying to raise money day in, day out at the launch pad at this program. And I said, you know what? Now there's a way for them to put a landing page up, raise money for their business that way. And that's, of course, going to be, hugely, massively disruptive. I remember reading headlines that were like, venture capitalists are going to be put out of a job because now the crowd is going to be able to pick
Mhm.
all the best new companies. And it's like, of course, fast forward to today, and it's like VCs are bigger than ever. And, the overall industry for crowdfunding didn't really grow as one would have expected. But I had built a compliance company to help make sure that when you're raising capital, you can basically verify that your investors qualify for certain exemptions, the ones that allow you to invest a lot of money. The term is accredited investor. For anyone who doesn't know, it's just essentially the SEC's way of saying you're rich enough to invest. And those means are essentially $1 million net worth or a couple $100,000 in income. So my technology verifies that information, because if you want to invest online, you actually have to share that information. And so we're kind of like a middle layer as a privacy layer, as well as an efficiency layer, because our technology makes it really easy to actually go ahead and share this information with us so that we can verify it, which means that you don't have to share it to the issuer, which would be like ridiculous, right? If you were like, Dr. Murphy's like, hey, you want to invest in my token, and you were like, give me all your net worth information, I'd be like, no, dude, I'm going to pass. But this way, you get a certificate that lets you qualify. And so running that business for 5 years as a CEO, I learned, I don't want to say I went to law school, but I definitely got a very good understanding of all the different securities exemptions that are out there for private companies, all the different compliance steps, the way that companies were digitally raising money. My technology fit into a lot of that. So I got to see a lot of that, and that converged into blockchain in 2017. We're a local company. I've been in Miami. I stuck around in Miami since. And a local facial recognition company. They were raising their Series B, very legitimate. They had venture capital, legitimate backers. And they were like, hey, can you help me do an ICO? You kind of know blockchain and you know this fundraising stuff. And I'm like, yeah, I could help you, but you're not going to do an ICO, right? Because I already knew that this was a serious problem, that companies were going to get securities violations. And I told them, we're going to work with the right attorneys. We're going to tokenize your existing shares. And that's what you're going to raise money with. This was the heyday.
Hey, Herwig, let me stop you. So 90% of the audience knows what an ICO is, and probably half of them have participated in them. But just, can you spell, what does that mean? And just make sure we're not losing people.
Sorry. ICO stands for initial coin offering. And so back in since Bitcoin came around, the biggest invention since then, I would say, was Ethereum launching smart contracts that enabled this craze called ICOs, initial coin offerings, where the technology of minting tokens kind of was introduced to the world. And people realized, hey, I can exchange my minted tokens for people's Ethereum, and I can raise money this way for whatever use case it might be. And so you saw projects raise, in some cases, billions of dollars via these ICOs, individual projects raising billions of dollars basically overnight. It was actually crazy to see. And of course, a lot of them were offering terms and rewards and incentives for investing that were just absolute no-nos in terms of the SEC, in terms of securities laws. And so the SEC had to go and enforce these ICO projects, and a lot of them shut down. A lot of them had to return these billions of dollars. Telegram is a famous company. That's one of them, right? And so I actually already had the foresight knowing that they were going to get shut down thanks to my compliance company. And so I helped this company do it the right way by tokenizing their stock, registering with the SEC a private exemption so that they actually were telling them we're raising money for this token. And then they limited their investors to the investors that qualified, which were international investors and accredited investors in the United States. They raised $12 million in 2 weeks during the height of the heyday. And that's when the light bulb moment went off. I was like, wow, this is going to disrupt all capital markets. And so I started a consulting firm to help others do exactly the same thing, and eventually stepped down from my compliance company to be able to do it full time.
Okay, so again, a lot of this is going to be elementary, but I think it's useful for at least some of the listeners. What specific? So the ICOs, they're bringing all this money, and then the SEC said, "Whoa, what's going on here?" And you kind of saw this coming. Was it just that it was so novel that technically there was no? I guess what I'm getting at is the things they were doing in the beginning. Was it just demonstrably you can't do that, or was it more like it was the Wild West, and you figured at some point they're going to come in and say you can't do that because it violates the spirit of the pre-existing framework?
It's definitely was the Wild West, because this was imagine this was a little bit like the internet coming around, and it was the idea. I would link it maybe akin to you can now launch a website, and the idea that anybody can put something on the internet via a website that anybody around the world can access. That was an incredible innovation. And now you're introducing this coin element to it, which was a transfer of value concept, where you now were able to essentially raise capital via a coin offering, hence the term ICO. And it was absolutely the Wild West. There were attorneys trying to give advice. There were some attorneys giving bad advice. And all it took was the ability to mint tokens in order to do an ICO, essentially, right? So it was definitely before it became common knowledge that you have to follow certain rules. It was anything goes, anybody goes.
Okay, and again, this is going to be so elementary, but just to make sure people who are new to this area. So you kind of had an offhand remark about, first there was Bitcoin, then there was Ethereum, and that had the smart contract capability in it, and then that's what spawned all these ICOs. And so it wouldn't make sense to say, oh, why couldn't a company do an ICO with Bitcoin? Because the point is people give you money and you give them coins that you create or mint yourself. And that's the whole point of Bitcoin is you can't just, one person just can't start cranking out more Bitcoins. And
You
so that's
nailed
why,
it.
right, okay.
Right, exactly. Bitcoin is just one universal ledger of one currency on its own protocol with its own consensus mechanism. Ethereum is a different one with this application to be able to essentially code on top of it, code onto the blockchain and create your own tokens, leveraging the same software, if you will. And so, yeah, it was anybody goes. It was, hey, this tool was out in anybody's hands. You could go out and market a token you had just created last night in your bedroom. And next thing you know, it raised millions of dollars because Telegram channels went crazy over the idea that you put out to the world.
Mm-hmm. And now the coins themselves, was the typical case, like there was some company that had a new idea of what they were doing, not necessarily involved in digital assets, but their funding mechanism, instead of conventionally issuing stock or just finding a bunch of private investors, was to, hey, we'll go ahead. I guess just like if they did a GoFundMe or something and used PayPal or whatever, like that's not using blockchain technology. It's just, that's one way, a way to sort of decentralized, to get more funding. That's what there is. So the ICO, it's not that the coin was like, hey, this is a better coin than Bitcoin. It's just that, no, this is issued by this particular company. And if you like what we're doing, you like our business plan, this is a very low overhead way for you to get equity in our firm. Is that the idea?
I'm glad you brought up that model. It was very much so akin to a stock offering. It was, hey, we have a project, we need money, we need investors in order to make it happen. And we believe there's going to be some kind of value. Now, the concept was the value is going to be generated through the token. And there wasn't actually terms put in place between you and I as an investment. Like when I bought your token, if you were one of these ICO issuers, as an example, I actually don't have investor rights that were enforceable in court to say, hey, man, like if you went and bought Ferraris with this, like I can take you to court because that's not what we agreed you were going to do. So it was very much so, again, the Wild West, which is why this was happening.
Okay. Well, yeah, I mean, I thought the whole point of ICO was to sound like IPO. I mean, is that true?
I think there had to be something there with it, right?
Okay, yeah. Otherwise, it'd be a pretty big coincidence. Okay. All right. So, all right, we did that. Now, I was going through your LinkedIn. So you've got a nice little catchphrase called "Wall Street without walls with Web3." So, besides the excessive use of W's there, what's going on with that catchphrase?
So the idea there that I think really breaks down what tokenization is in a funny, catchy way is Wall Street has always been kind of a club, right? It's you have to be one of the big banks to play, or you have to have large amounts of money as a fund to be able to really move the market. The little guy, the retail is usually sort of considered dumb money, right? And so what's cool about tokenization, and I use that term with Web3, because that's sort of the catch-all in this case, that tokenization unlocks Wall Street for everybody. This idea that, okay, and this is what's happening, this will happen, there is a disintermediation that will happen because you are broadening the opportunity set. All right, we're saying is by tokenizing assets, we're going to create digital markets for them that anybody can access in a regulated manner, and therefore you're going to have more competitors, you're going to have more bidders, you're going to have fairer markets, you're going to have hopefully more liquidity for that asset class before it ever existed. So that's the idea behind tokenization is Wall Street without the walls anymore, because now we can digitally invest into what used to be a club where we're going to get access to all these amazing investment products as individuals.
Well, it sort of dovetails too with the accreditation process. And I know with regulated, even digital offerings, there's accreditation and, know your customer, that sort of thing. But I'm just saying the general idea, like ostensibly, the reason for those rules is, we don't want some school teacher puts her life savings in this offer, into a hedge fund, and it goes belly up and then up, she's destitute. So it's like, only accredited investors can get into some of these things because they can afford to lose that money. But then on the flip side, it's this sort of paradoxical situation where if there's a really lucrative, like, this is all the smart money's going into this thing. But you can only come in if you're rich. Poor, no, people who have modest means, you're not allowed to get into this thing that all the rich people think that's where I want to put my money. So it is sort of this interesting bifurcation.
The best returns are in asset classes that are typically not accessible by the individual, by the non-accredited individual. So you're spot on about that.
Okay, so now, but to unpack a lot of what you said there, so this idea of tokenization, again, we'll get into more of the depths of it for the experts out there, but big picture, someone might say, oh, is that kind of like Bitcoin, like what you were talking about a minute ago? Like what does tokenization mean, and how is that different from cryptocurrencies, let's say?
The CEOs of the biggest asset manager and the biggest bank in the world basically just both were on CNBC saying, hey, tokenization is the future of finance. And they use this word tokenization specifically referring to taking digital or taking these securities, these financial instruments on finance, if you will, on chain by tokenizing it and putting it all on a ledger that everybody can get access to and trust, because finance is so disintermediated and so locked up between different middlemen that the tokenization makes things more efficient. It allows for instant settlement. It makes more transparent with the data, which makes it easier to actually access and do things with. So long story short, it is the future of finance. And if I had to just kind of punchline it, we're killing Excel and PDF. This is how the entire, there are memes about this, of the entire world's infrastructure basically being pinned around Excel and PDF, right? And somebody who's typing on a keyboard. That there are mistakes that happen. There are issues. There are lag times that all get removed thanks to the use of blockchain. And so there's a very big difference between Bitcoin and crypto, where you're using the technology of blockchain, where you're using it for your own token projects. What we're talking about when we say tokenization is the tokenization of finance and putting everything on chain. I think it's crazy to me that basically a little over half a century ago, we had the great paper crisis on Wall Street, where Wall Street had to shut down because we were still relying on paper being traded back and forth to basically manage the accounting. And it just got so built up that it just had to shut down. Like, that was not too long ago. And the solution to that, the legacy architecture, is what we're still using today. And that's why this is the new future.
Okay, yes, that's a good analogy, just to make sure the listeners, or make sure I'm getting what your point is, that it's back in the day, at some point, like if you wanted to buy shares in a company, like there was a transfer of paper to show up, those are my shares of stock. And then obviously, as of 1995, you log in, or let's say 2005, the average person's logging into his account and buys some shares. It's not that he's getting mailed anything, or even that somewhere else physical paper's changing hands. That would be crazy. And we're fine with that. And so your point is that we're now seeing a new revolution, and 20 years from now, no one's going to think anything of it. That you say, oh yeah, I own a bunch of real estate over in Dubai. And they say, well, how do you know? Because here, I got this digital token that represents this thing on the blockchain right there. You can go verify it. So that's what I mean. All the courts recognize that I'm the owner of that piece of real estate in Dubai. And that's the duh. Well, what else would we do? That's so obvious.
Why would you go back to pen and paper if you've got that technology available to you?
Okay, but you're saying what we're moving beyond now is not just the pen and paper. We're moving beyond. So Excel and PDF got rid of transferring parchment with wedding signatures, but now you're saying what they're doing is killing the Excel and PDF.
That's right. The PDFs and Excel sheets, they got to get moved around. There was an incredible announcement by JP Morgan, who worked with Apollo and Wisdom Tree, two major asset managers. And they each basically contributed a fund, if you will, to this pilot, this proof of concept, where they put them all actually on different blockchains, put 3 different funds from 3 different asset managers on 3 different blockchains, and were able to do a rebalancing of the portfolio and basically essentially compare the two between traditionally and on-chain, and recognize that in just a few steps, which we probably would be called clicks, you're actually taking 3,000 operational procedures down to just those few clicks, because there is so much back office work that has to happen on PDF and Excel that everybody needs a copy of, that everybody needs to update, that everybody needs to send around and get approvals and things like that, that for you to rebalance a portfolio, it's incredibly complicated today.
Mhm.
Not if it's on chain.
Okay, this is interesting because when I've heard people, and I was going to bring this up, so I'm glad we just kind of went right into it spontaneously. A lot of the pushback I get in certain circles, ironically, it's not from old fuddy-duddies who, I don't trust these newfangled ways, but it's from Bitcoin maximalists who say, no,
Sure.
the only thing the blockchain is good for is Bitcoin. And all these other people talking about, smart contracts and this, they're just buzzwords. They either don't know what they're talking about or they're lying to you to get your money. And so when I ask them, where do you talk? And they, elaborate. And so there's different responses, some of which are like, oh, the transparency and you can see it's there and everything like that. And, the trustlessness, there's lots of applications where that's a great thing that you want. But one of the Bitcoin Maxi's trump cards is to say for anything besides something like Bitcoin, doing it in-house in an internal database like SQL is just so much more efficient that the blockchain is a terrible way to keep track of stuff, except, and there's one thing in human history of Bitcoin, namely, so one thing, Herwig, is, my response to that was always like, that'd be like saying the printing press was good for making the Bible, and that's it. When no, you could imagine it. So like, it just seemed weird to me that you'd think the blockchain, the only thing it would ever be good for was that. But that's, anyway, I'm just underscoring how you're like almost tackling their objection head on, and you're saying, so can you just unpack that a little bit, that experiment or demonstration you just talked about, that actually rebalancing a portfolio on the blockchain was in some sense more efficient than doing it the old way?
Well, what blockchain is at the end of the day is it's a better data technology, right? It's a better data warehousing tool that allows this concept of smart contracts that creates essentially if-then statements for your asset. Which, just imagine that today. Again, how would you do that with your stock that you own through your brokerage? How would you do that with the investment you made in your private company? How would you do that with the title of your home? You wouldn't be able to do any of those things. Those are what we will call dumb assets, if you will. And we're going to make them smart by putting them on a blockchain. And you need a blockchain in order for everybody to trust the data that we're all going to use regarding what the information is for your asset, right? Otherwise, we're going to have a very complicated and centralized data solution that absolutely, can be corruptible. The data can be changed. It could be lost. That could create a lot of problems for a financial asset of any kind, a loan, a security, an equity, right? So blockchain is being used in many different use cases. And the beautiful thing about on-chain assets or RWAs, real-world assets, or anything like that, is that they follow the same set of rules legally. And so in order for us to program and use these assets that are living in the real world, if you will, and make a token out of them, all we need our blockchain to do is follow the rules of the law. So for example, what I mean by that is if I have a company share, I can't just give that to anybody if it's a private company. There are rules preventing me from just giving people shares in my private company. But if I have a token that anybody can just trade, well, then how am I preventing and how am I going to follow the rules? So you need to have actual smart contracts that say, hey, you are not allowed to, Dr. Murphy, trade this token because it is a restricted token. It would be illegal for you to just give that to somebody else or trade that to somebody else. So those are the rules that get programmed into the asset, into the security, so that now you can have a compliant digital representation via a token. And now you can use that in all of these cool use cases that have come out in crypto. Well, an example of collateralization by, again, can't do that with your Apple stock. Can't do that with your private company. Can't do that with your title. You can't just go walk somewhere and be like, hey, give me a loan against this, right? It's a complicated process. But if I have a token that represents that asset or that security, and somebody has already said, hey, I'm willing to lend against that token because I like that asset, boom. There is a programmatic trade that happens. I never have to talk to a human being at all, and I have just collateralized my asset. So this is cool on an individual basis. But also BlackRock just did this with JP Morgan's tokenized collateral network because they're also doing it and they also see the value. And so that's what's so cool about all this.
Yeah, so let's talk about that in a little bit. So you alluded to it a second ago here, and then I saw that you've been talking about on social media. You called it the CNBC Media Tour for Tokenization 2024. So Larry Fink from BlackRock, and then Jamie Dimon and from JP Morgan. So again, these are household names. This isn't some computer nerd or some wacko libertarian, of which I'm one. That's why I speak like that. So can you just elaborate? I still think there's a group of people that are like, oh yeah, this is all the latest fad, but it's been the latest fad since 2008. So can you just speak a little bit about that? Like, how mainstream is this becoming?
Yeah, this is going to happen in the background, whether you like it or not. So, for example, there is an asset manager called Wisdom Tree. They've actually have a history of launching ETF products. And over the last couple of years, they actually spent an entire infrastructure investing into companies, buying, getting licenses to be able to essentially launch an app. It's only an app. You can download it, in I think it's over 30 states now. And what this app does is it allows you to buy into their digital fund products. And this is really cool. Why? Because the infrastructure they've set up, you are not basically getting a wallet or a token or anything like that. But what you are getting, instant settlement out of your trades every day. They'll be adding all of these options like collateralization. Part of their vision is to be able to issue a credit card so that you can literally pay out of your investment account real-time settlement that is able to allow these purchases to happen. That could only happen on an on-chain infrastructure. And so they have done the work of now having over 10 or over a dozen products registered that you can then just via an app, you're buying it. No one might ever realize just that this technology is happening. What they're just having an easy way of accessing investment products that are going to make them money. And so that's what's cool. That's what's going to happen in the future. You're going to see it in the background. But then for those of us who want it, like Franklin Templeton, for example, they've been going to a bunch of different chains. And Franklin Templeton, for those of you who don't know, is a $1 trillion asset manager. So I'm giving names of mainstream, large household finance names that are leveraging this technology today. And they launched a money markets product. Basically, you get access to treasuries rates and things like that. And they have it issued on 6 different blockchains. 6 different blockchains where you can access this product because they're trying to make it accessible to different communities that want to leverage or access this product via their blockchain. So the world is going to be very interesting. I expect to see assets be multi-chain, so they support multiple blockchains or they're on multiple chains, as well as you're going to see different issuances of the same product on different chains, as well as just some that are exclusive to chains. And if a lot of what I'll end on is just that what we see in a lot of the big finance households is they're creating their own ecosystems, their own private permission networks, because they need to be able to be in control of the different aspects of the technology for them to compliantly do this stuff. Whereas what you are seeing in the DeFi and in the other side of the world is you're seeing more of the custody first, self-custody. Republic did this recently where you can buy into some of their products where you self-custody the asset, which means you'll be able to do all these other cool things with it yourself. And I'll say this, all of the heads of digital assets from the big banks, they say that eventually the future is going to be public blockchains.
Okay, great. So a lot of terms there. Let's just go through and just unpack them a little bit.
Yep.
So what's the difference between a public blockchain and then maybe what some of these other ones that are more like in-house proprietary? Can you just explain the difference between those?
So this is where I want to comment about what you recently brought up regard the Bitcoin maxis, right? And the idea that no matter what, Bitcoin will always be around. It can't be stopped, even if it's made illegal. Bitcoin it will always function, and it has never been hacked, right? And so it is the most secure data ledger in the world. And so there's a lot of value to that. But the reality is you don't need that in order to take advantage of a lot of these applications that we've been talking about. And unfortunately, Bitcoin has a lot of compliance concerns, a lot of issues, as we talked about, unless you're using their liquid blockchain, which is basically their smart contracts layer to Bitcoin. It's very difficult to use it. So what a lot of these banks have done is created a private version of them, a permissioned version, if you will, which means they control who has access to the blockchain, who has access to the information, who even has access to the consensus mechanism so that nobody can corrupt the underlying data, so that they essentially have full control of the blockchain application. And in some cases, they're not even blockchains, they're distributed ledger technologies, but we won't even go down that path. It's just they are creating their own technical environments, because that's kind of the punchline of what I'm talking about, is that this isn't about crypto. This isn't about a Bitcoin movement. This isn't about that. It's about the technology and how it's just going to make current capital markets more efficient.
Okay, yeah. So I'm glad you framed it that way, because that is exactly, I think, what the issue is. Because again, some of my best friends are Bitcoin maxis, right? And so I ask them, I say, look, I'm not mad. I'm not taking offense. Just tell me. And at least I got to the point where I understood where they were coming from. But and I think it sounds like you're going to agree with me that by them saying, oh no, the whole point of Bitcoin is to have it be public. Like you say, there's thousands of copies of the Bitcoin ledger all over the world. And even if various governments destroyed 99% of them, still there'd be enough here and there they couldn't stamp out. And eventually that would propagate and everybody would remember who owned which Satoshis or which addresses they went to and blah, blah, blah. They can't get rid of it. And that's very useful for that one particular application of what they want it for. But like you're saying, there's other arenas where it might make perfect sense to have a thing where not everybody can come in and just download the protocol and then start playing some role in whether the next block gets added to the chain. And so and it's not prima facie obvious why you wouldn't want to consider in between stages like that. Yeah. So can you maybe speak a little bit? So I think what they would say is, just again, to play devil's advocate here. Okay, well, if you guys are admitting it's not a fully public blockchain that anybody can come in and download the protocol and jump in to ensure that there's no hanky-panky going on with which transactions get approved, then why not just keep it completely in-house? If you're basically just trusting JP Morgan or BlackRock or whoever is going to make sure the right kind of people are in network, why don't I just say, well, okay, so I'm trusting them anyway. Why don't they just do it internally on a dedicated database server instead of this farce of it's a blockchain, but it's not public. Like, what the heck is it? All right. So you get the idea that sort of objection.
Yep. It still features the same safety mechanisms for data safeguarding, right? So you're still able to have essentially a distributed mechanism that makes sure everybody has the data, right? You can go to any bank or anybody on Wall Street and ask them if they trust their counterparty. They do not. That's the entire point and how finance is built. So that's actually why the very use case of a blockchain, and in many cases, a public permissioned blockchain, is what the best solution is. That's where you get the best of both worlds. You get to take advantage of the fact that the data you're using is verified, that it's not been changed, that is correct, and you get to use the technology of smart contracts for instant settlement, for collateralization, for data transparency, et cetera. But just like you said, you can control who the actors are. One of the biggest benefits that people love about tokenization, security tokens, RWAs, if you will, is the fact that you actually can lose your asset. A lot of people always ask me, well, hey, I can lose my Bitcoin. Why the heck would I want to be able to lose my stocks, right? Of course, why would you? But no, this is a regulated environment. In order for you to be able to technically, legally be buying tokenized investments that represent stocks and other things, that means they have to follow the rules and the regulations, which means they're doing the KYC, the know your customer checks, the same checks that you would do when you sign up for a brokerage firm, so that they know, hey, we know who you are. And actually, because it's on the blockchain, we can see what happened. And if you somehow lost your keys, or if somehow someone hacked you and ran away, first of all, they'd know who they are, because there would have to be, maybe they stole somebody else's identity and they took your stock and they're running away with it. The beautiful thing is, doesn't matter. They can freeze that. They can burn that. They can basically stamp those stocks as stolen, useless. And they can then mint you new tokens to a new wallet, or however you want it, to be safeguarded, because at the end of the day, the token is not a bearer instrument. Make that very clear for anybody who may be confused about this. The token doesn't just represent your ownership in it. It is tied to your identity. It is tied to your legal investment, which is usually either in the form of a terms and conditions signature or an actual signature on like a investment subscription document that proves that you own that. So this is just a digital receipt. This isn't something that, hey, if I manage to steal your wallet and I see all these stock tokens in it, that they're suddenly my tokenized stocks. No, they'll always be yours and they can be easily sent back to it. You cannot lose your investments.
Okay, great. Yes, so this is very helpful. I'm trying. Let me just throw this out at you, and then you tell me. I'm going to come up with an analogy. These things are never quite analogous, and then you maybe give me feedback on it, because I am trying to put my own finger like for myself, and then also like to communicate it once I'm square in my head on this of the difference. So let's say we're talking about sheep, okay, and then there's like 6 different ranches or something around, or let's say cattle. And one model would be you go up to the ranch number 1, and then they just internally they have like a notebook and they keep track, and they say, oh yeah, Joe Smith, he has 13 sheep with us that are his. And the idea is if they lose that piece of paper, or if they're corrupt, or they just make a mistake, and they say, no, you've only got 8 according to our records, you're out of luck. You say, no, I had 13. They said, no, you don't. We said, you're done. But then a separate model might be like, okay, they have like the fencing in the middle of this town square, and representatives from each of the 6 big ranches are there. And any sheep coming and going, from that barbed wire, all 6 of them have to be there and sign off on it. And so still, like if all 6 of them got together and colluded, but they're all kind of in competition with each other too, and it's just more public, but yet strictly speaking, do you get what I'm trying to go? I'm trying to like isolate, like with the permission.
I think it's a great analogy. That's actually really, I actually really like it. The reality is that Notepad right now is a PDF or an Excel sheet. And that's what everybody's relying on for accurate information, for doing trades. There are loan books of just Excel sheets saying, hey, there's 100, 1,000, 10,000 loans in here. And here is the relevant information about each loan. And that's an Excel sheet that's sent over. That's our Notepad in the ranch. And right now, blockchain is creating the town square post so that people can go and register their trades and make sure that everything is accurate and no one's trying to create any tomfoolery or just any disaster avoidance. So I think it's a great analogy. That is not, we don't have that today for public markets or private markets. And tokenization enables both to basically come online, to become digital, to become tradable in a legal manner. That's the most important thing. And that's here today. I think we're going to see a lot of that in 2024.
Okay, great. By the way, I also appreciate your use of the word tomfoolery. That's the only one that I like even more than that is skullduggery, which you may want to.
That's a good one. That's a good one.
Add that to your bag of tricks. Okay. All right. Well, okay, good. So I'll keep playing with that because again, I'm trying to, like I say, once I understood where the Bitcoin maxes were coming from, I was like, okay, but still, maybe I don't want to catch you off guard here, but because they were bringing up, and I think it's related to what we're talking about, that, oh, well, because the beauty of the reason the Bitcoin protocol can get away with evades all these problems they're bringing up for every other possible use that someone might come up with is that its own internal, it doesn't refer to anything. Like to say I have 3 Bitcoins that I have the private keys to and I control, it's not pointing to anything. All that means in the grand scheme of things is that I have the ability to transfer those to other addresses. And then, and so if the rest of the world doesn't care about that, if they think Bitcoin's stupid, then that's useless. But if, we're in the current environment where they have, a lot of people are willing to trade a lot of US dollars for a, control of a Bitcoin, then it does make it matter. And whereas they're saying a lot of these the smart contracts and I own real estate in Dubai and this digital token points to that, they're still saying there's still got to be something in the real world responding to that. Like there's elements where they might say it's an Oracle problem. Like, we were thinking of a lot of life insurance applications here at Infineo. And ultimately, how does the blockchain know if somebody died? Like somehow there's got to be a way to get, and you can program smart contracts, but so there is some element where there's various choke points But to me, it's like, well, okay, but in theory, there's hard forks and stuff in Bitcoin that are possible too. You know what I mean? So
Yeah.
none of this is truly as pristine and, impervious to human intervention as they claim. And to me, it seems like it's more of a spectrum, and that, yeah, and you can still imagine. I can imagine a lot like, okay, I think there's a lot of consensus as to about whether a person's dead or not. Now, granted, if he just disappears, maybe we don't know, and there should be, some. But if there's a corpse sitting there and he's got the DNA match, it's like I think we
Yeah.
could be pretty safe in saying that guy's dead. So anyway, I'm wondering if your reaction on that point about the oracle problem and that blockchains only work if there's not an oracle issue and da 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 da.
Yeah, at the end of the day, tokenization just makes it better. If you look at the death certificate example, it's like you actually right now in the crypto world, you have actual estates all around the world dealing with a real problem of like, we can't get access to crypto holdings, or we don't know how to manage them because it's brand new territory. But when it comes to our world, what we are talking about is a world that has decades, over a century, basically, of rules around and regulations around how we treat those things. And the technology is just a better way to manage it, a better way to efficiently use it. I think that the way that I always like to say is like you break it up into two angles of, okay, well, one end, you have a better data solution. That's just what it is. Now it's more transparent. People can accurately use it. On the other end, you have the smart contracts, and you can actually do all kinds of other cool features with it that actually were never even introduced before. So those are two different things. At the end of the day, both of them don't exist for a lot of the world's trillions, hundreds and trillions of dollars of private companies, of bonds, of debt products, of loans, of real estate, and the list goes on. And so to have something that is at least a better solution, even if it's not perfect, like that to me, trumps the argument of, yeah, let's stick to what we have today. Even on the case of Bitcoin, to the Bitcoin maxi specifically to address them, it's like I like to look at, Samson Mao as a big proponent of, again, the liquid chain where you can actually use the Bitcoin ledger to essentially issue tokens using their liquid technology. We saw the same technology be used by El Salvador's president for volcano bonds. They plan to tokenize government bonds that are backed by Bitcoin mining, and that Bitcoin mining is powered by geothermal energy from the volcano bonds. So this is all Bitcoin. And the president of El Salvador realized, like, I can't issue a government bond on Bitcoin without this technology, and to do it this way, in a tokenized way, in a regulated manner, because otherwise no one will take that bond seriously. So he had to do it this way. So, in order to kind of bridge the world of, again, nothing bad against crypto, but the virtual world of crypto versus on-chain finance or real world assets, real securities, real equities, there's going to have to be, some level of bridging where, oracles and other things and everything else comes as best as possible into play.
I'm still just hung up on they figured out a way to monetize their volcanoes. That's amazing.
They sure did.
Besides the tourism element, right? Okay, well, as we're wrapping up here, let me just ask you, I guess, your thoughts for the future. So one big thing as we're recording is recently the Bitcoin ETFs got approved.
Right.
Just, whether that or just more broadly, what do you see coming, either US specifically or globally? I guess one thing I'm asking a lot of guests from your area of, specialization, are the regulators around the world, are they on board and saying, yes, this is the wave of the future, and so long as the digitization happens along these ways, I guess we're okay with that, versus, trying to stop it and saying, oh, wow, we don't like this?
I don't think anyone is against this tokenization trend, other than some people may prefer the permissionless. I would like to anonymously be able to own stocks of things. That's just a world that cannot exist with the world's regulations everywhere. But everybody else says, hey, this is cool. This is better. I want things more efficiently. I want things faster. I want to be able to collateralize more stuff. I want to be able to pay for stuff with my stocks. I want to be able to self-custody them. All these features are both very, very interesting to the professionals on Wall Street and very interesting to a lot of people in the world of crypto. And it should be very interesting to a lot of individuals. And we're already going to start seeing that. There's a platform recently called Reserve that launched in partnership with T0. And it's a company focused on hotels to tokenize hotels in order to encourage their guests to buy stock in their hotel. And if they do, they get a discount at that stay, or they get free stays or benefits and experiences. So the idea of merging customers and shareholders is going to come. I love to use the example of AMC popcorn. Most people don't realize that if you're an AMC stockholder, you actually have a right to free popcorn. You get a free bag of popcorn. And how do they do this? You go online, you go to their website, and you say, hey, I want to redeem my free bag of popcorn. And how do they prove that you own that stock? Well, you mark a checkbox that says, hey, I solemnly swear that I own a share of AMC stock. And they don't care whether they do or not, because at the end of the day, it's a marketing stunt. Mm-hmm. But the point that I'm trying to bring up is with a blockchain, they actually could. You actually could show up and say, hey, here's my AMC stock tokens. Mm-hmm. Give me my redemption, please. And they could actually officially execute a marketing program. So we're going to see this tokenization trend in finance, in commerce, everywhere, in all use cases. And what Larry Fink and what Jamie Dimon and even Jeremy Allaire, the CEO of Circle, just came out and said the same thing. We're at a turning point where this was a signal to the market that this technology is here. There's a use case, an Ethereum ETF is being talked about, right? So that kind of gives validity to, again, the smart contracts angle. That this is a turning point. This is finally, we're here. People accept this technology, not for what crypto is, but what for tokenization is. Mm-hmm. And that it's going to make capital markets way better, finance way better.
Well, I mean, people who listen to this podcast, perhaps hoping for stock tips or whatever, I just think now they know how to get a free bag of popcorns. So that right there justifies listening to this episode.
You want better.
Yeah. But folks, remember, you don't lie, right? It's selling your soul for a free bag of popcorn. It's not worth it in the long run. Go get that AMC stock if you want the popcorn. Not giving financial advice. I'm just giving a conditional statement.
Popcorn advice.
Okay, well, thank you. So, folks, my guest this week has been Herwig Konings. Herwig, thanks so much for your time and your insights.
Absolutely. It's been a pleasure. Hope to be on again soon. Thanks for the time.
Yeah, maybe when the Ethereum ETF is close to launching, we'll bring you back to talk about the issues involved.
I won't hold my breath.
Okay, thank you everyone for tuning in. We'll see you next time.
This concludes another episode of InFi, the Future of Finance, with Dr. Robert Murphy. The information provided is for educational purposes and does not constitute financial advice. Consult with qualified professionals before making any financial or investment decisions. For more information on the host and for previous episodes, visit InFi, thefutureoffinance.io. Thanks for listening.